most reasonable investors would dismiss them as absurd. Normal aging and investment risk, really some pretty good things that come out there in terms of research. Older investors benefit from the experience that they've had. They trade less frequency and they exhibit a greater propensity for year and tax loss selling. They have a stronger preference for diversification, and they're not as influenced by the behavioral biases that I've been talking about today. So all of those are basically positives that come from our experience as investors. However, the difficulty comes for us through some of the normal aging process that can affect memory. I'm there. How we process information and attentional ability. I think the question as we go forward is, how can we know when some additional help makes sense for an individual? The adverse effects of aging eventually dominate the positive effects from our experience, and it will be different for each of us. The issues highlighted in an article in the New York Times, go back a page, the gentleman here was highlighted in New York Times articles, and I've put the articles and where to find them down in the lower left-hand corner. There was a 9 or 10 article series in the New York Times that's worth reading when you have a little bit of time. But this gentleman who was 73, or at the age of 73, began giving money away to a single mother, and things snowballed badly for him, and he ended up losing his home and really all of his savings. And today he's suing a number of people, including a gentleman who purchased his home for fraud and for taking advantage of him at his age. And the challenge for that is, at what point does it make sense for someone to step in and help versus the right for an individual to have their own independence? These are very tough issues that we're going to be dealing with in the years to come more and more. We encounter it to some degree, in particular on the trust side of our business, and they're tough ones to come. I want to shift now to what we have to do to get things right. We need to be able to spot fraud. There are things that we can do to counterbalance the hardwiring that we've got in ourselves. Maintaining healthy skepticism, we need to be less gullible in general. And then there are specifics on investments and managing portfolio risk. I'm going to start with how do you spot fraud on the next page. I've got two sides of information here on this slide, and let me comment briefly on the right side. There are common threads that are found after a fraud has been perpetrated. There are common threads that were evidence that it was a fraud ahead of time. Some of the things are the words that are used. If somebody's offering you a security or investment where they say it's insured or guaranteed or risk-free, those should be red flags for you. Some of the names of the securities, bank guarantees, prime bank notes, they don't even exist as a security. Those are red flags as well. A pressure to act immediately and make a decision now. Claims of special expertise. Some of the certifications that are available today, special senior advisor certification or whatever, they're basically worthless. There's very little additional education involved with them. I went out on the internet and did a search for high yield investments. If I was someone who was trying to increase the return on my portfolio, that might be one way I would do it, is how can I find some investments? I need more yield. I mean, treasury bills are only paying basically a tenth of 1%, and the longer term bonds aren't paying particularly well. What could I do? I did this search, and two of the first 4 sites that came up near the top were essentially full of lists of firms offering some kind of investment. And I would venture a guess that the vast majority of those were fraudulent. I put a picture here of one part of a website that I ran across, and I've blocked out the names of the guilty here, innocent. We don't want to make sure that nobody files a lawsuit against Mission for this. But in the middle of this doesn't show up very good here on the overhead, but I think it probably is okay on your hard copy. They're offering returns of up to 3% daily. In another place, they indicate guaranteed income. And they've got an effort here And right where the U.S. flag is and right underneath where these interest rates are, you can probably read what they say there, where they're trying to reassure U.S. investors. And this particular site was listed in a country in Central America. On that exact same page where I did the first search, you know how when you do a Google search, all kinds of advertisements come up to the right and up above. These are some of the advertisements that came up. Here's one. Invest in high yield, trading fund, everyone accepted, earn 2.5% daily profit, stable. At the top, 9,000% of your deposit after one day. Somebody acts on these things or they wouldn't be doing it. Somebody, and when you can put these ads out at a very, very low cost and only pay for the link in, it doesn't cost these guys hardly anything. And in fact, they only pay when they get a pretty good hook on the line. They catch a fish and start to reel them in. Somebody's coming through. These things just jump off the pages at me. Well, this is all in the first part of Google, and yet we hear about fraud after fraud. Time and time again. We just heard about just last week there was a pretty sizable alleged Ponzi scheme that was discovered in Denver. If you're not sure, if you're looking to do something, get some help. Ask a friend or a family member. Just get a second opinion on what you're seeing. There's some very good resources out there on the internet about how to spot fraud. And actually the next page is a picture of a couple of those. The Financial Industry Regulatory Authority, or again what used to be the NASD, has a couple of things up on their website. On the left, we have what they call their scam meter. And I went through this little exercise and I put some stuff in here. And what it does is it asks, like 10 questions about an investment that I theoretically have been offered, and tries to identify what's the potential that there's some high risk here, that this could be fraudulent or a scam. And then it came up, I just entered the questions, and it came up with like a four red flags in the questions that I answered. And one of the things was, does it use risk-free or guaranteed in the advertising? I had said yes. On the right, you've got a risk meter. And it's in the similar vein. What it does is it asks you a series of questions and identifies whether you as an individual, based on how you answer your questions and your behaviors, whether you might be at a little bit greater risk of becoming a fraud victim. On the next page, what can we do to offset how we are hardwired in our processing? In general, I think the important message here is to keep an open mind. You just don't want it so open that your brains fall out. We live in a complex world, and some of us are very certain in our decision making. I tell you, watching my teenagers, and I have one who's a young adult, these kids, they just know. I'm sure like I knew, and you couldn't tell me anything at the same ages, and mom and dad, we just don't get it, at times at least. Listen to those who disagree with you and be less certain in your views when it comes to your assessment of risk. Don't take information at face value. Who has the other side of the trade? And what do they know about what they're selling that you may be or miss? Why are they selling it? Okay? If you're in a transaction to buy a home, why are they selling their home? The other thing to keep in mind is, even though we're now aware of these kinds of emotional and cognitive biases that we have, that they are stubbornly resistant to being overridden. We fall back on them time and time and time again. And so you really have to be very forceful and find very active ways to offset. Another way to get it right on the next page, maintain healthy skepticism. And your greatest guidance there probably comes from Carl Sagan. He was the classic skeptic. Extraordinary claims require extraordinary evidence. At the core of economics is the first bullet point, Tan-Staffel. There was a book written, the title of it was Tan-Staffel in 1946. And this first started to appear, I think, in the early part of the last century. It is, there ain't no such thing as a free lunch. And we forget that. And a great example of this is in the Nigerian frauds that we see. All of us get emails through on those